where your wealth is residing, it's often representing a financial institution. And the first place that comes to your mind is the commercial banks. And I have something really important to tell you. The commercial banks aren't your friend. We're going to talk about positioning your capital for financial opportunities and mitigating risks. Most of what you may hear is, can I only do just one thing? Should I invest for opportunities or should I mitigate risks? And in our world, it's really about why not do both? Your money must reside somewhere. And this is going to be the solid foundation where this is how you'll be able to actually start implementing both. Because when you have your warehouse of wealth, you can start building it from there. I just want to talk about is where your wealth is residing. It's somewhere for you right now, and it's often representing a financial institution. And the first place that comes to your mind is the commercial banks. And I have something really important to tell you. The commercial banks aren't your friend. At an early age, you've been probably trained very, very well by them to hand them all of your money. And they've even conditioned you to pay them to hold on to your money. So it's not that they're paying you, you're paying them. It comes in bank fees or transaction fees, you name it. So I just want you to think about it. You've been made to believe that there are no other options available to you. Now, why would there be? Because if there is, there'd be competition. So all of your money flows through someone else's bank right now. And they certainly most wouldn't want to ruin their control on society with their position, because apparently they know what's best for your money and you don't. So eventually, if this continues, what does that mean for all of your wealth? I mean, you are already practicing the process of banking today. It's just that you are using someone else's commercial banking system to do it. So how so? You deposit money in there, you borrow from there. I mean, it could be the same commercial bank that your deposits go to, or it could be a different one. I mean, the Canadian money supply, which is the money that's created, is created by the Central Bank of Canada. They're basically one and the same. It all ends up in the same place, which is the Central Bank of Canada. And then it eventually is centralized back to the two global banks, the World Bank and the Bank of International Settlements. And after all, they've got a banking system that controls all of it. So I just want to share with you some of the concepts that we're going to work through are coming from these places. Becoming your own banker from the pioneer of this concept, R. Nelson Nash, building your warehouse of wealth from R. Nelson Nash, and keep taxes away from your wealth. First thing is we're going to design the specifications of your storage container that you have control. And the second is putting together a warehouse that you own and control. The third is putting the storage container inside a warehouse that you own and control, on top of land that you co-own. This is your warehouse of wealth. Because what happens in here is a repellent to the banking system and the government. Before we go into this, let's see how entrenched your mind is on the current banking system and how much it has a grip on your mind. Just listen to someone when they say they hate whole life insurance. The first thing that comes in my mind when I look at them is this. I mean, the very definition of the word insurance is to protect. It's a contract which an individual or entity pays an insurance company in exchange for financial protection or reimbursement of losses resulting from a covered event. So for the whole life, just because they're so blinded by their opinions doesn't mean you have to too. Is your life and your loved ones' lives not important enough to protect it for their whole life? I mean, is there any disadvantage to exercising Nelson's golden rule of don't do businesses with the banks? It's just too bad. Not everyone's going to want to. But the fact that you are here means you are in the right place and means you are wanting to. So congratulations. If there's anything that you're going to digest, I just want you to free your mind from whatever information you've been programming yourself with for whole life insurance. And try to stay away from opinions or uninformed opinions from those who actually may not even have a policy or a system of policies or really just distaste it. Come with an open mind. So what you want is to create a system of properly designed dividend-paying whole life insurance policies to practice the process of banking. And now not all life insurance licensed advisors have the training around this. So the first step is actually properly designing it. What you may not know is a whole life insurance policy is as broad as a category as driving a car. The difference is how those cars are designed and what they achieve when they're designed a very particular way. So there's flexibility in how whole life insurance policies can be designed. And when it's designed properly, at least the way that we want to practice it in accordance to becoming your own banker, as Nelson has intended, is to practice the process of banking. So we can claim that we have created policies and it's going to do all these wonderful things. However, I want you to ask whoever you decide to work with or discuss this with is how have they used their properly designed whole life policy as it relates to implementing it in their life. Now, if you meet with any of our team members or our coaches, definitely ask that question. I can share with you, I've used it in many ways, things like renovations, things like debt recapture, things like investments. Now, the way that I'm going to use it, the sequence and order and how I use it is going to be different than yours. And you get a really personalized discussion when you set up time to meet with us or talk with us. The first step is really a properly designed whole life insurance policy is just a tool to do the job. The second is working with the right coach who uses it to help you get to your wealth destination. And I just believe at Ascendant Financial, we live the lifestyle, we love the process, and we implement the process of infinite banking. How it's designed to help you do the job and the coaching you get to use after you have it is what matters most. I mean, this process works. So get yourself a coach who uses it. It just so happens we do teach it and we help others do it too. Isn't it obvious that now is more important than ever to become your own banker? Get yourself on this path to becoming your own banker and continue the momentum that you're on. So make sure you schedule a call with a coach, your coach, by scheduling 780-809-4599. So you need to implement your own warehouse of wealth. And really, if we take a comparison of looking from depositing your capital, you have capital or money, where would you deposit it? In your warehouse of wealth or in someone else's commercial banking system? Well, if we take a comparison, your warehouse of wealth will have a death benefit. Someone else's commercial banking system doesn't have a death benefit. Your warehouse of wealth will have uninterrupted daily increase in capital. By the way, tax-free. Someone else's commercial banking system, if you withdraw it, you're going to interrupt any compounding interest if they do actually pay much of it to you. So it's very limited to no increase in your daily capital. You can earn dividends because the way that we structure it is to place the policy with a mutually insurance company so that you are a co-owner and you get a share of the profits in the form of a dividend. Now, you give deposits to the commercial bank. I'm sure you deposited your paychecks. You deposited money transfers. You deposited revenues from your customers. Add up all of that money and think about how much dividends did that commercial bank pay you for giving them your deposits? I think the better question now is asking, how much do they charge you for you giving them your deposits? Now, when this is set up properly, and this is really discussed on a personalized individual discussion, it all happens in the consultation clarity meeting. Now we talked about that depositing side of where your capital is going. What if you need to access the capital? One of the options is you actually borrow capital. So you can borrow money from the commercial banking system or your own warehouse of wealth. And when you do, when you borrow money from your warehouse of wealth, the repayment frequency, so you can decide whether you pay it back weekly, bi-weekly, monthly, 2 months in, quarterly, all of that is decided by you. You don't need permission from anyone. But if you borrow money from the commercial banking system that you do deposits with, they're going to decide when you make payments. If you put money in your own warehouse of wealth and you borrow capital from it, you can decide when to pay it back. You can pay it back whichever time you feel like to. Of course, we want to encourage you to be disciplined. When you borrowed money from the commercial banking system, whether it's, again, the same commercial system you used for your deposits, maybe you used and shopped around and found another commercial bank and their commercial banking system, you're borrowing money from that system instead, well, they're still going to decide when you need to repay it back. When you're borrowing money from the company you co-own, there's no credit qualification. From the commercial banking system, credit's required. You're going to have to provide sensitive, private information like your T4s, like your bank accounts, like your debt, like your other loans that you have from other people. Maybe you have a low credit score. When you borrow money from your banking system or your warehouse of wealth, it's not restricted for use. You can decide to use it for paying down loans. You can decide to use it for a vacation. You can decide to use it for buying a car. You can decide what you want to do with that money. You don't have to ask for permission. When you're borrowing money from the commercial banking system, they're going to decide what you can use it for. And here's how the loan is secured. It's collateralized by the cash value that the insurance company has built. And if the loan isn't repaid, there's a lien on the death benefit, meaning whatever the death benefit is owed to your beneficiaries, if there's an outstanding loan that you've borrowed, they're just going to subtract it against the death benefit. Whereas for the commercial banking system, they're going to place personal collateral and liens on your own assets that you've built. If your way of building wealth and financial freedom is real estate, and your spouse has passed away, which the mortgage was underwritten for under 2 incomes, including the property, and your spouse is the higher income earner, maybe you don't qualify for that loan anymore. So they may start capturing more of wanting to get their money repaid back. There's a difference here. So why would you build your wealth through at someone else's bank? When you give them your money, here's what the banks do. Well, let's take a look at a very, very unprecedented time during lockdowns. The commercial banks still made money. They made $29.7 billion in interest. And for the deposits that they got from their customers, they paid $12.4 billion in interest. That's what they paid you. Here's another bank. They paid $6.7 million interest. That's what they paid to depositors. And then here's what they earned from those deposits, which was $16.7 million in revenue. And here's another one, 10.27 paid in deposits and 34 million received in interest. They're going to make a profit from it and share none of it with you. And it doesn't even matter if you're struggling. So that's like asking a snake not to eat its prey. And if you continue using them, and this is what could happen to your wealth over time. What I want to highlight for you is you are already practicing the process of banking. It's just controlled by someone else, not you. So let's first talk about money. Money is constantly changing hands and leaving you. When we talk about you having money and you're going to pay the credit card, that money that you have is going to be sent to the credit card company. So that's money being transferred away from you. When we talk about you borrowing money for buying a home and getting a mortgage, well, that's money being transferred away from you because you're making payments to them. When we're talking about taking things like food, things that you need to live, and you having to take money and use it to exchange for those goods, you're going to get those goods of food. Someone else is going to get that money. It's being transferred away from you. If we talk about the money that you are going to use for leisure, entertainment, relaxation, like a vacation, you have the money now. And once you've gone through the experience, you've transferred the money to an experience and someone else has gotten the money from that experience. What about for clothes? Money's being transferred from you having the money to you getting the clothes. So now you have the clothes, someone else has gotten the money. If we talk about what direction your money is moving from you toward away, all of your money is being transferred away from you. Whether it's for appliances, home renovations, food, credit card, clothes, mortgage payment, vacations, investments, it's money leaving you. So when all of that money moves away from you, how much money would you generally have today? Zero. Money's coming in and money's going out. So what this means is there's a permanent transfer of money away from you. I'm not sure if you'll be that happy about it. So here's a big reason for that. If your money is important for you, you're going to want to focus on keeping it instead of giving it away and protecting it from being taken away from you. Capturing the earning potential by depositing it into your system first. When you pay cash, you are losing the earning potential. So money is being given away and you're not able to earn interest on the money that's being given away. The other option is borrowing money. You pay interest. So when you're getting money from someone else, particularly the financial institution or the commercial banking system, you're going to pay interest for it. There's no negotiation with that. Every decision you make with money is a financing decision. So notice how someone else is getting all of your money and not you. So let's walk through a very simple example to demonstrate this. And I'm going to introduce the concept called opportunity cost. Opportunity cost is the potential foregone profit from a missed opportunity, because this is the result of choosing one alternative over another. So instead of paying $1,000 for food and groceries, that's option one. Option two is you have an availability of taking $1,000 and putting it into a 1-year GIC at 5%. $50 is the 1-year opportunity cost because you had two choices. Choice one would have given you $50. Choice two is giving you, let's just say, your biological body, energy and sustenance. So you're making a choice on that. But from a financial standpoint, the opportunity cost is $50. Instead of paying $100,000 for expenses, cars, food, groceries, taxes, it could be put into that 1-year GIC, earning 5%. And now this opportunity cost is $5,000 in the 1 year. If we exclude compounding and repeat this pattern of progress every year, where $100,000 is going away and assuming interest rates for the GIC still 5%, the opportunity cost over that 20 years is $100,000. Is your wealth important to you? Yes or no? So the focus is to build and fortify your warehouse of wealth. Because if your wealth is important to you, you are going to defend and protect your wealth. So what are you defending against? Well, are you in control of market volatility? Are you controlling changes in policy for tax rules? Are you in control for changes in interest rates? Are you in control for lockdown measures? Are you in control of economic uncertainty? Are you in control of rises in bankruptcy? Are you in control of decrease in consumer spending? If you're not in control of your wealth, then who is? It's someone else. Again, the one who's controlling all of that money supply. What I want to make sure you are aware about is that there's a system that they have which you have no input, influence, or control over. There's other people, which isn't you, who controls what's going on and can negatively impact you. Here's what's really not fair for you or not in your favor.
Fair to say you simply flooded the system with money?
Yes, we did. That's another way to think about it. We did.
Where does it come from? Do you just print it?
We print it digitally. So we as a central bank, we have the ability to create money digitally, and we do that by buying treasury bills or bonds or other government guaranteed securities, and that actually increases the money supply. We also print actual currency, and we distribute that through the Federal Reserve banks.
They can just print unlimited amounts of money with the stroke of a button. So you're told to work for money, and just to kick you while you're down, they confiscate a majority of it. Taxes on wages, paying sales taxes, spend your own money, paying income taxes, already taxed. When I die, pay the death tax, that was already taxed. Tax on tax on tax on tax. So the more effort you put in, the less of it you get to keep. And they also introduce new tax laws every year that you have no control or input on, just to force you to pay more taxes. Here's Canada's government spending. And if we look at the government's budget, we can see the frequency of how many times they've had surpluses compared to the frequency of the deficit that they've had. What I really want to highlight is the size of the deficits that they have. So common sense says if you're spending more than what you're bringing in, at least for you, you don't have the same availability of tapping into the printers, but they do. If we look at the quantity or amount of their debt, we can see it was still a lot before, but now it's astronomical. And where is the money going to come from to cover their continued deficits, number one, so spending more money than what they're bringing in, and the debt that they already have that they weren't bringing more money in compared to what they're spending? Where's that going to come from? It's going to come from you. And it's not just by doing things like increasing taxes in 1 year. That's not going to solve the problem right away. It's going to be throughout your lifetime, and it's going to include your future generations. So by not implementing your own warehouse of wealth, your future generations are already inheriting debt before they even started. Just imagine, they've come into this world so that when they reach the working age for their very first job, they're going to be told they need to pay for taxes. How does that even make sense? Do you think Caesar and his puppet masters are going to take care of you? So I want to introduce a couple of mine, Brandon and Jenny Wilson. They're 38 and 36. They have 2 children. One's a firefighter, the other's a registered nurse, and together they earn $175,000. Now, they're actually both tired of losing half of their money to Caesar, and they sought coaching from me. And they've implemented IBC now for almost 3 years with their system, putting together, depositing $50,000 or transferring $50,000 annually. The government program have balances of about $130,000. and it's earning on average about 4,000 annually, which is 4%. They were depositing 30,000 annually into it. They had a real estate portfolio, which is about $650,000 in fair market value. The rental mortgage was on variable interest rate at $178,000, and their net cash flow was $18,000. They have a primary residence, which is $1.2 million fair market value, with a mortgage of $600,000 and a HELOC of $100,000. They have a very special mortgage, which if they pay down the principal, they would be able to also access the equivalent or a rise in their HELOC in terms of a line of credit. They had car loans, which were $40,000, and they were paying about $1,200 per month. And they had lines of credits where it was about $40,000 with a target payoff at 60 months. Again, 3 years ago, the interest rates were not as bad as what they are today. So they wanted to make sure that at the end of all the money that is flowing through their hands, they've kept something and they could leave something behind for their children. So where is all of their money going? It could be, food, groceries, everything like that. But what I've categorized it for all of you to see is they have money coming in from rental income, their salaries, their investments. Where is it all going? 19% went to the commercial banks in the form of interest and principal. 18% was for living. 33% went to the government. 30% went to the Wilsons. This seems pretty respectable, right? Or is it? When the Wilsons are the one bringing in all of the money and they're keeping 30% of it and 70% is being sent away to someone else. So what they did was implement a strategic wealth management plan, which is by me, their trained coach. First, the car loan of $40,000 had a repayment schedule of 60 months. So what we did was first recapture the car loan into their warehouse of wealth, which was to pay off their car loan and bring it into their system so that they can control their own repayment terms. And by doing that, because of the advantages their warehouse of wealth has compared to the non-advantages the commercial banking system has, here's how long it would have taken them to pay their car loan, 60 months. Here's how long once they've transferred it and put it under their own schedule, under their own favorable terms, 15 months. So like the Wilson, would you enjoy controlling the repayment schedule from 60 months down to 50 months? So imagine what you will be able to do if you get back 45 months of your life and your earning potential, because it's not going to the commercial banks and from them taking it away from you. We can talk about the numbers and how much money they saved and interest and all of that stuff, but let's talk about what's important. 45 months of their time just got back for them and controlling more of their money away from their takers. Where is all of their money going? So let's say they started 3 years ago. Remember, 18% was to living, 33% was to the government, 19% was to the banks, 30% was to the Wilsons. When they implemented IBC and controlled the car loan right away, so in year one, and then they were going through their disciplined process to repay the loan, government was still getting 33%, living was 18%. But what shifted? The banks were now not getting 19%, they were getting 15%. The Wilsons have captured back more of the money coming in from 30% to 34%. So most financial entertainers don't focus on helping you regain control of your wealth. Their focus is just moving your money into the next latest, greatest trendy product. But the Wilsons were tired of giving their money away to others, especially the commercial banks and Caesar. So when the central bank, Bank of Canada, decides to, without your input or control, to do this, from having the interest rates at 0.25%, increasing it once, increasing it twice, increasing it thrice, increasing it again, 10 times. The Wilsons went from having a positive rental cash flow of $18,000 per year to now losing $3,600 per year. For the Wilsons, a shift of $21,600, which was $18,000 to a losing position. So it wasn't $18,000 to zero, it was $18,000 to $3,600 losing position. So $21,000 was leaving them annually because their $100,000 HELOC interest and their $40,000 line of credit interest was averaging 4% initially, turned and ballooned to 7.5%. In case you didn't know, most of these lines of credits aren't going to be that 5% bank or prime rate. They attach a premium spread on it because those banks who are distributing those lines of credits have to actually make a profit off of you when they give you that credit. So that's why it's 7.5%, at least for the Wilsons. So for their HELOC interest, just pinning that down, the money went from them paying $5,600 ballooned to $10,500. That's pretty painful. So 3 years later, after the interest and the confiscations of the new taxes that was introduced, CPP2 and all these other new taxes that were being introduced. Well, remember, starting 3 years ago, the Wilsons were getting 30% of their money. Still, it was still a problem. Just, it got a little bit better after they controlled one of the loans and repaid that off. But it got worse because of all of these inflation, the taxes, principal that they had to pay for the loans that they borrowed, the interest because of the rise in interest rates. So the government started to get 38%. They moved from 33% to 38%. The banks moved from 15% to 25%. The living went from 18% to 20%. And all of that was being taken away, not within their control. So the Wilsons got left with 17%. It's not like they could have said, I wanted to keep my 34%. Everyone gets the rest of what I get to keep. It's actually everyone else forcefully got what they got, taking it away from the Wilsons. So the Wilsons got a lot less. So even with us working together, those changes cut the Wilsons' share of money coming in half. Instead of 34%, it fell down to 17%. And there was another problem. Their positioning of their capital that was residing in those popular programs that Caesar offers to Canadians were no longer keeping up with the interest they were paying to the bank for their HELOC and line of credit. What does that mean? Because the capital that they were residing were earning less than the interest they were paying. With both of those locations, deposited money and money being sent away, both of those locations where the Wilsons' capital were going to, they had no idea whether it would go up or down. They don't know when interest rates were going to go up again for their debt. They don't know if the principal or the earnings of what they were getting in those popular programs from Caesar were going to go up or down. They had no idea what's going to happen. What does that look like visually? Their financial asset was growing or giving them an annual payout of $4,000. But on the other side, the loans that they were getting or what they were paying because of the increase in interest was $10,500. They were lucky that their assets in those programs were growing still at $4,000. On a net basis, they were losing $6,500. It made no more sense to them to maintain or hold on to those government programs. So because sometimes you might forget, the Wilsons would ask a genuinely honest question. Should I continue to build my investments or should I pay down my debt? That's the question that I find myself facing with clients actually on a daily basis. And I just thought you probably have that same question. I mean, when it comes to becoming your own banker and having your own warehouse of wealth, why not both? Why does it have to be either that or that? Because with their money residing in Caesar's programs, the opportunity cost was at least $6,500 a year. So they proactively took matters into their own hands to regain control. How did they do it? They added another storage container inside of their warehouse of wealth. And they did this by transferring an additional $20,000 per year of their money into their system. And this time, it's away from residing in someone else's warehouse of wealth. And that was transferring the capital that was residing in Caesar's programs to their own warehouse of wealth. So what did that look like? On this side, you'll see the wealth residing in Caesar's program and what's going to happen over time or what was already initiated. And then on this side, you're going to see the warehouse of wealth as it relates to the Wilsons. So they were on a process that started $100,000 and they were winding that down, $20,000 net coming back to them at a time. And just by starting, by putting it into their warehouse of wealth, using the tool that we use, it already locked in the insurance company into a legally binding financial agreement to have a death benefit to be paid if and when anything were to happen, which is tax-free. In today's world, when taxes are higher, tax-free becomes a lot more precious or valuable. And in their process, if they were to graduate at once, their exposure to taxes would have been approximately $30,000. And then if they melt the balance down, then it'd be $24,000, $18,000, $12,000, $6,000. So this is what the journey of their capital would be, assuming, because we don't know, whether taxes remain the same. But we're just using what we have today. And by relocating that capital, this is where the deposits were being added into the system. And with it being added into the system, here's the value of the asset that they have availability for. And at the beginning, it's slightly less than the deposit. It is slightly less than the deposit. And then over time, you notice how it matches the deposit, and then it starts exceeding the deposit that was put in. And this is only just a snapshot at the beginning of the years, because one of Nelson Nash's golden rules is to don't be afraid to capitalize. Well, the Wilsons surely are not afraid to capitalize here. And by doing this, they've created, using an asset that is shielded and has exemptions out of the income tax code, which prevents Caesar from making unilateral policy decisions that enrich himself and those who control him. And this is all because they have desire. And it's on page 65 of the book, Becoming Your Own Banker. Because without it, you probably can't do it. This is what the difference is. They have the desire. And really, the concepts I'm talking about is beyond just the tool, just the product. It involves the driver of this vehicle, which is the Wilsons. You have some free training that you can further your learning journey with, and it can be accessed at watchibc.com. So if you're tuning in on YouTube, make sure you visit watchibc.com just to access that free 90-minute training to learn about the details about becoming your own banker. And if you haven't, I really encourage you, get yourself a copy of this book. So how many of you feel like you aren't taxed enough? We're going to talk about a very special concept, which is transforming their rental property situation to be much more favorable and using the tax code to help them instead of harm them. So the Wilsons are doing all of the work. Caesar's getting all the money. Caesar has a very high spending habit for himself. I don't know if all the flights I have gone on accumulated to $200,000 of airplane food. Caesar also has a very luxurious lifestyle. I haven't been to Jamaica, but I don't think it costs that much. I also haven't been to $6,000 per night hotel. I would actually love to enjoy that, but definitely I wouldn't pay for it. I'm sure Caesar found a way not to pay for it. One of his most recent vacations were $287,000. How many of you would love that as it relates to paying down some debt? Caesar also enjoys getting into a lot of debt. This clock is running up every day, and your share of that is going up. Same with how much that's growing per day. I mean, there's rules for thee and not for me. $59.5 million for an app that doesn't work, that sent people into quarantine for the wrong reasons. Caesar's also hypocritical and enjoys virtue signaling you on how you should live when he doesn't follow the same. And you know what the best part is for Caesar? He doesn't have to pay for any of it. It's coming from someone else. He also has a mafia of Agent Smiths who does ensure he gets paid, though, because he needs to keep up his lifestyle and his spending habits. So please don't evade taxes. It's not a smart move. And what frustrated the Wilsons even more is watching every new year, all the introduction of new taxes. What did that look like? New taxes and penalties and filing obligations, like the increase in carbon taxes April 1st, 2024. How about this bare trust filing that got everyone completely losing their mind and the professionals losing over $1 billion in professional fees that is not going to be refundable to clients because they changed their mind. They shouldn't even have it in the first place, in my opinion. If you run Airbnb as a business, there's no more ability to deduct expenses. What an exception. How about this alternative minimum tax? There's a second tax code to make sure you pay taxes at a minimum level. How about this annual underused housing taxes? So if you have an empty house, you've got to pay taxes for an empty house. I thought property taxes already was part of that. How about another CPP called CPP2? What's next? The rain tax? Oh, wait, there's already some discussion about that happening in Toronto. So not only did he indebt himself with spending, he's enslaving you to pay for all of his spending. And here is the pièce de résistance, the generational tax. Fairness for every generation.
Some people don't think that the richest few should pay more in taxes. Well, I don't agree with that. At a time when the richest are only getting richer, I think it's fair to ask those people to pay a little more. You may have heard of the capital gains tax, or what some people call the capital gains tax advantage. And if you don't know what that is, you probably don't get that advantage. It's basically where you've made enough money and amassed enough wealth in assets that you end up getting a tax break. Here's what I mean. Everybody pays taxes on 100% of their salary.
And here are some of the comments that came from that. More wedge politics from Prime Divider, pitting Canadians against each other. This is just asking doctors or any professionals that make good money to leave the country. There's no incentive to live here at this point. There are 12 likes on this video, 600,000 are dislikes. And he's also enslaving your future's generations, for some even before they came into this world, to pay for all of his spending. And here's some of the things that you may not have been aware of that has happened actually over time. Corporate tax on families splitting income in 2017, that was removed. Corporate estate planning using a special component called the pipeline, 2023, closed. Corporate surplus stripping, closed, 2023. Income taxes now primarily favoring salary over dividend, happened in 2024. The alternative minimum tax, 2024. 50% income tax rules introduced in 2019. Passive income tax rules. Corporate capital gains increased to 67%. Inclusion, 2024. All of the advanced estate and tax planning that apparently the wealthiest of wealthiest enjoy have been removed. And there's just so much more in just a short period of time. So significant efforts were put in to close all reasonable efforts to maximize his confiscations. No matter how tyrannical Caesar is, the Wilsons are great Canadians who will still pay their taxes. But the Wilsons decided to take control of how they paid for his confiscations.
I've been pointing out that some Canadian households, and it tends to be the better off households, do have quite a lot of money that they've saved because there hasn't been that much to do in the pandemic. And certainly it would be great if that money could go towards driving our recovery. And I want to make an offer now to all of your listeners. If people have ideas on how the government can act to help unlock that preloaded stimulus, I am very, very interested. Maybe, as Doug Porter was suggesting, it happens by itself. That's the best case scenario for me. But if people
if you're not looking at things beyond just 1 year, you're going to be in for a huge surprise. So let's go into the Wilsons' rental property situation. They had a rental real estate portfolio, just to recap it all, $650,000 fair market value with a rental mortgage of $178,000, which was variable. And now you know it was unvariable. So their profit or their cash flow went from $18,000 down to $3,600 loss. Their primary residence was $1.2 million with a mortgage of $600,000 and a HELOC of $100,000. Now, working with me, the Wilsons changed the way they paid for their mortgages, their HELOC, their taxes, because they focused on positioning their capital in their warehouse of wealth. And here's what we could do. The Wilsons made their principal mortgage tax deductible. So before, remember how they were monthly getting $1,500 as a net cash flow profit. After all of those new confiscations were introduced, they were losing $300 per month. Now, after implementation of making their principal mortgage tax deductible by utilizing the tax code according to how it is supposed to be used, we've transformed that from $300 per month to $500 per month. And by doing things this way, the Wilsons were also specifically able to enhance it and actually accelerate their principal mortgage repayment even higher. So that enhanced their tax refund even more to pay for their property expenses. Wilsons focused on paying their warehouse of wealth first, and then had their warehouse of wealth pay down their principal mortgage. And by following this process, because they've done a really good job of setting this process up early, and for us having such a great and working together, because I want to help them as much as, well, I mean, because they're just great people, here's what happened to their mortgages. The time saved from controlling the mortgages using their warehouse of wealth. Obviously, this plan is still underway. However, there's very good clarity in how it works right now. So before, their principal and rental mortgage was going to take them 30 years. That was their amortization schedule. Following this process, implementing it right away, and continuing their same financial discipline, their principal mortgage, in terms of that repayment plan, shrunk to 15 years instead of 30 years. And their rental mortgage shrunk from that 30 years to 7 years. So by following this process, it transformed their principal mortgage interest that was not tax deductible to be tax deductible to decrease their tax bill. Brought some more of that money back to the family. We transformed their monthly property net cash outflow to a neutral to positive. We accelerated their principal mortgage payment even further and created a faster repayment schedule, taking advantage of their expense deductions. So that's all paying down debt, getting more cash back into their hands, and while all of that, still growing their generational wealth and capital inside of their warehouse of wealth. It's not an either or an or, it's an and. And all of this is from repositioning their capital. The Wilsons could continue to do all the hard work, bring the money in, take all the risks, and still lose money, as you saw. Because the commercial banks' interest and Caesar's confiscations are ready to take it all and give half of their efforts to Caesar instead of their children. Instead, they chose to meet with their coach, which was me, fight for what they cared about, brought clarity to their financial situation, and prioritized them. That's what we met to do. They set things up in a way to build an asset, which was their warehouse of wealth. We focused on positioning their capital so that they could pay for themselves first and build the asset before Caesar and his henchmen took their confiscations. We focused on changing the way they paid their taxes. Everyone pays taxes by depositing and building money up in their commercial bank storage container. The Wilsons just did it differently by building up their money up in their storage container, which was situated in their warehouse of wealth. The Wilsons understand there's a cost to everything. Money leaving them means opportunity cost. They can't earn anything on that money once it's gone. So your warehouse of wealth works differently. It's in your favor of you and not them. If you were to take something away for, ask yourself, why aren't commercial banks working for you? Why isn't Caesar, who's taking his confiscations from you, working for you? Free your mind from the conditionings of the commercial banking system. And here's the updated protection plan from them. Remember, after the confiscations, the government was getting 38%, the banks was getting 25%, living was 20%, Wilsons were left with the 17%. Instead, we've nudged it and shifted it up to 23%. This is on an annual basis. 22% from the banks, which dropped from 25 to 22. The living stayed the same, and then the fell down to 35%. And this is just for the money coming in. This is not including, because they think long range, the fact that they are going to save a lot more time paying off those leashes of credit debts on their mortgage, principal mortgage, and their rental mortgage. So for them, they're putting less money into building generational wealth, where they can leave more money behind for their children. With the ability to pay the commercial banks off 15 years earlier and being in a position to consider retirement at 53 instead of waiting until 65. In other cases, it's actually 68. Having the peace of mind knowing that their warehouse of wealth is legally protected under century-old contract laws that are established and not at the whims of those who are running the policies of Parliament Hill. And this is why the importance of becoming your own banker is so important, because once you have created your warehouse of wealth, you can start the journey on becoming your own banker. And how you use your capital from your warehouse is different than everyone else. There's infinite possibilities in how you are going to use it. I just showed you how the Wilsons used it. And with good coaching and experience from me, I'm just trying to help them get ahead. So it's just an exercise of an imagination, reason, logic, and prophecy. So here are your options. The first one is do nothing. Now, when you do nothing, you can keep things as they are and continue letting Caesar and the commercial banks bleed you dry through the rules that they control, like taxes and interest. You can wait another year and leave your wealth positioned in a way where there are sitting ducks for more of those confiscations. I mean, they're likely already gearing up to launch more attacks on your wealth. Option 2, you can choose to get this process started, reclaiming the control of your wealth and shielding it from things you don't have control over. Your journey to financial control for you and your family rests with you, not with anyone else. There has to be some honest introspection at this point and a commitment to get out of financial prison, and it must be a burning passion. Choose making the earning potential on all the money that flows through your hands. You are handling the money. How can we help you earn or have the earning potential for all of the money that you are handling? And to do that, make sure you schedule a call with us at 780-809-4599 if you haven't gotten this process started. That way, you've already made the commitment and investment to watch and learn about this concept. Don't put it to waste. Continue the momentum. Our team would happily love to get connected with you so we can help give you more information so that you can learn about how to further your journey. If you're already working with our team, please make sure that you have put together and know how to position your capital further to keep it away from the elements that you don't control.